All right, let's dive straight into this explainer. We hear it literally all the time. That glossy dream where you can just flip a switch, sip your morning coffee, and watch the crypto profits passively roll in. But today, we're tearing down those shiny expectations and looking at the hard reality of how Pionex trading bots actually operate.
Here is our roadmap for today. We'll be covering 1. The promise of automated trading. 2. Who actually holds your crypto. 3. How these trading bots functionally work. 4. The hidden costs and network risks. 5. KYC and Account Security. And finally, 6. Why these are tools and not profit machines.
So let's jump into Section 1, the promise of automated trading.
It's really easy to see the appeal here, right? Pionex completely strips away those massive technical barriers. You don't need a computer science degree. You don't have to wrestle with separate platforms or connect incredibly complex API keys. You've got grid, DCA, and futures bots built right in from the start. You literally just pick a strategy, add your funds, and theoretically let the bot do the heavy lifting while you're fast asleep.
But, and this is a massive but, we need a serious reality check. A trading bot is absolutely not a profit machine. It doesn't have a crystal ball, it doesn't magically sense when a crypto asset is about to suddenly tank, and it definitely won't protect you from terrible settings or ridiculous leverage. A bot just blindly follows the exact rules you give it. Nothing more, nothing less.
Because of that, we really have to flip the script on how we evaluate these kinds of platforms. Instead of asking the incredibly vague and kind of unhelpful question, is Pionex good? You have to actively ask yourself, does it actually match my specific trading plan? What about my personal risk tolerance? Does it fit my country's regulations and my own specific withdrawal needs?
Moving right along to Section 2. Who holds your crypto?
This is a fundamental concept we simply cannot ignore. Pionex is a centralized exchange. Sure, it's highly convenient, kind of like handing your keys to a valet, but it introduces major centralized exchange risk. While your crypto is parked there, you do not control the private keys. The platform is running the wallet system. So the absolute smartest play: only keep your active trading funds on the exchange itself. Consistently move your long-term, hold forever bags to a self-custody wallet, where you and only you hold the keys.
Now you will see that Pionex publishes proof of reserves. That's essentially evidence showing they hold the assets to cover customer balances. And hey, that's definitely positive information. But listen, it's critical to understand that this is not a complete financial audit. It doesn't guarantee they will always be perfectly liquid, and it doesn't wipe out legal risks. Treat it as a solid green flag, not an ironclad guarantee.
Speaking of guarantees, you know what the biggest threat to your funds is? It usually isn't some crazy high-tech exchange hack, it's user error. So lock your account down, use a completely unique password, turn on an authenticator app, and seriously, skip the SMS option. It's way too vulnerable to SIM swapping. Ignore those random support DMs flooding your Telegram, Discord, or X, and always double-check the official URL before you even think about typing in your password.
All right, on to Section 3, how trading bots actually work.
Let's break down the mechanics of the two big players here. First up, grid bots. These guys place buy and sell orders within a very specific price range that you define. They are absolutely brilliant for choppy, sideways markets where the price just bounces up and down. But they're kryptonite? If the asset dumps hard below your range, you are stuck holding a big losing bag. On the flip side, we have DCA, or dollar cost averaging bots. Instead of dumping all your capital in at one single price point, the bot spreads it out, which is a fantastic way to reduce the risk of buying the absolute top. But again, no magic wands here. If the asset enters a multi-year death spiral and never recovers, a DCA bot is still going to lose your money.
Then we step into the danger zone, futures bots. When you combine automated strategies with leverage, the stakes absolutely skyrocket. Sure, leverage amplifies your gains when you're right, but man, it accelerates your losses just as violently when you are wrong. You're introducing the very real risk of total liquidation, meaning the exchange just force closes your position because you're out of margin. The bottom line, for beginners, futures bots are infinitely more dangerous than spot bots. Please, master basic market structure and risk management before you ever touch leverage.
Which brings us to Section 4, hidden costs and network risks.
That visible advertised trading fee, that's literally just the tip of the iceberg. Think about it. A spot bot might place hundreds, even thousands of orders. A tiny little per order fee compounds massively over time. And with futures bots, oh, you aren't just paying base trading fees.
You're getting hit with maker and taker fees, constant funding payments, the bid-ask spread, all of which eats into your margins lightning fast. And don't forget network transfers. Blockchain withdrawal fees are all over the place. If you try to save a couple bucks by picking the wrong, cheaper network, you risk losing your funds entirely.
Because sending crypto into the digital void is basically irreversible, you have to treat this three-step withdrawal process like absolute law. Step 1, confirm the exact crypto asset and the specific blockchain network on both the sending and receiving ends. Step 2, triple-check the deposit address and verify if it needs a memo or a tag. Step 3, always test with a tiny amount first. I cannot stress this enough. One small mistake here is totally fatal to your capital.
Moving to Section 5, KYC and Account Security.
Pionex requires KYC, Know Your Customer. You probably know the drill by now. It's the standard identity verification for anti-money laundering rules. It dictates your limits and requires real government-issued ID, plus usually a selfie. Listen to me on this one. Do not try to game this system. No VPNs, no fake addresses, no using a buddy's ID to sign up. If you feed them false info, you will inevitably trigger a compliance review down the line, and your funds will be completely locked up on the platform. Just don't do it.
Finally, let's hit Section 6, Tools, Not Profit Machines.
To wrap this explainer up, let's be crystal clear about who this is actually for. Pionex is ideal for traders who want simple automation without needing to know how to code Python. It's for people who truly understand the specific risks of grid and DCA bots, who play by the KYC rules, and who practice safe wallet habits. But it is absolutely not for you if you demand 100% self-custody of your assets at all times. And it's definitely not for anyone chasing some pipe dream of guaranteed, totally hands-off passive income. At the end of the day, Pionex is just a highly capable utility tool. Bots can execute your strategy perfectly, but they won't magically turn a terrible strategy into a winner, and they certainly don't remove market risk. Automation makes execution way easier, but it should never, ever replace your own personal risk management. So I'm going to leave you with this final thought. If a trading bot is literally only as smart as the person setting it up, are your current trading rules actually disciplined enough to be automated? Definitely think about that before you fund your next bot. Thanks for joining me on this explainer, and I'll catch you on the next one.